Hello guys, how are you? And welcome back for another exciting video. And as usual, here we only give knowledge and knowledge and knowledge. Yeah, but keeping it simple. Yeah, nothing complicated here. We only do simplicity. Yeah, simplicity, simple knowledge here. So we have a pair here. It's a volatility to 51 S index. It's in the D1 time frame. I love these higher time frames because they have weight. Yeah, they're not like the lower time frames. Yes, if you're a scalper, you can use the lower time frames, but if you're a day trader and especially a swing trader, you'll use these higher time frames. So beginners, let me show you, and this is for beginners, intermediates, and the professionals. Yeah, this is how we keep it simple here in this YouTube channel, the Tsunami. Yeah, just as the name suggests, we are the Tsunami here. We are family. Yeah, and guys, please help me reach 10k subs. We are just starting and we are going far. Kindly help me reach 10k subscribers to motivate me so that I'll be posting frequently, so that you get the knowledge required in order to harvest from these markets, forest markets. These brokers, we must make money from these brokers. Yeah, wake up, we must wake up, open your eyes. I'm giving you simple knowledge, simple strategy to maneuver these markets. Let's go. If you look at this market structure, yeah, if you look at it, there's something common you'll see. Like I said, here we are keeping it simple. If you look at it, obviously the market is in a downtrend. Yeah, it's coming from the upside going down. And if you look at it, the market has been from this point here, the market made a dip here, and it went back with a higher high, a lower low, a higher low, a lower high, another lower low, breaking this previous low, came this lower low, a lower high, lower low, another lower high around this region. Then it continued that way to the downside until where it's currently at. Yeah, so if you just look at that structure, we know we are looking for sells. The market is bearish. Okay, and here we just use simple strategy. The chart patterns, we use the wedges, the flags, and the pennants, only those ones. Yeah, and with my experience in these markets, I've realized almost all these strategies are the same, just terminologies are what differs and where you enter. And the mother of all these strategies is supply and demand. Let alone those things that people talk of a lot. Oh, you know, this, what, nonsense, what not. Just keep it simple. The goal is to make money from these markets. Yeah, we are not here for terminologies. We don't bank terminologies in our accounts. We only bank them dollars and some pounds and euros, yeah, that we reap from these markets. So if you look from the at this, you know, at this trend, you saw it's a bearish trend. Yeah, and let me show you what we'll be using to maneuver and the strategy you'll be using in any pair. Yeah, let's go. Let me show you. I always use trend lines and they work, guys. Let nobody lie to you. These trend lines work. They really work, and they can give you some sharp entries if you know how to use them and I'm going to help you know how to use them. If you look at this market, obviously being that it's going to the downside, and I said we'll be trading chart patterns, meaning basically we'll be looking for chart patterns like the bearish flag, bearish pennant, and the bearish wedges. Those are the only things we'll be looking at, being that the overall trend is bearish to the downside. So we only look for flags, the bearish flags, bearish pennants, and bearish wedges in this bearish market. Okay, like I can see so many here. Yeah, let's go. This is the past data, but we can use it also to show you what you can expect in this market. Being that it's bearish, if you look at this point here, starting up here, we had a pattern made like this. If you look at it, it was a rising wedge, and rising wedge usually breaks to the downside. It goes when it goes, it's a bearish wedge, yes, but it's a rising wedge, meaning it will break to the downside. It also looks like a flag, but it's more of a wedge than a flag. And the secret of these flags and wedges is this: you always look to the left. Yeah, you always look to the left. So whenever you want to enter, look at this point of interest to the left. Here, it's a supply and demand zone. Price, before going down, most of the time it comes to test an area of confluence to the left, then goes to break the lower trend line. If it's a bearish market, it will go and break to the downside after testing the supply and demand zone. Then again you go downside, if you look at this here, I'll show you all these flags that are in this market. You also have another one here. Make sure it touches the wicks, 3 or more points for it to be strong. And like I showed you earlier, for your TP, you just measure the inside of the channel like that, and you come and place it. So meaning your first TP for that first bearish, for that rising wedge would be here. Your first TP will be here. Then it's very perfect. That first TP is very perfect, that being that when the price reached it, it started consolidating, creating another wedge pattern, more of a bearish flag here. Okay, and again we can just do the same thing over and over again. There's no need of complicating anything. Just keep it simple as possible. Let's measure the first TP of this second wedge. You measure the inside of the channel, then put it like this. Whenever price reaches the first TP, it consolidates or retests, and at times it can retest and go back to this trend line to test it, then goes for the second TP. Let me confirm something here. For the first for a rising wedge, for the second TP, you do that, place it like that. You measure from this point, that area of confluence, that point here, to the lower trend line like that. Then you place it here like this. You can see your second TP would have been somewhere here, but after a lot of holding, because this is the D1. Yeah, but the same applies in all the time frames. It's the same for every time frame. It doesn't happen only on the D1 or higher time frames only. The same applies even to the lower time frames like the M1, M5. But the difference is those time frames are really fast, especially if you're a beginner. Kindly, I'd advise you to stay away from them fast. Those lower time frames are very fast and they can confuse you. But first, for your peace of mind, you can just use these higher time frames, the H1, H4. Basically, let's say from M30, H1, H4, D1 if you wanna hold for long. Yeah, but with the time, after gaining experience and practicing, it will all be easy. Again, here there are a lot of flags. Even in this one pair, you can just see the patterns and how many of them we've come across. Another one is this. You can see there are a lot of rising wedges that fall to the downside. The same applies here. What we did up there, we also do here. Like here, I said before the price, yeah, eventually goes to break the lower trend lines. If it's a bearish market, it first goes to test this area of confluence, what we call the area of supply and demand, around this region. Yeah, test it, then breaks to the downside if it's bearish. The same will apply to here. Down here, you look for area of confluence to the left. It was here. Then wait for nature to take its course. You can put your limit orders around that region and wait for nature to take its course. After the price goes back, after the price comes to that point, it will eventually break after testing and hitting other people's stop losses and collecting limit orders that were put around that region before breaking the downside finally. Let's look for another one. Here I can also see something here. Let it touch 2 to 3 or more. And again another one. We put it down here. Okay, and if you look at this one, you can see the price tried breaking at this point, that it made a fake breakout. Yeah, it made a fake breakout. So if you did not know what you're doing, the market will really punish you here. It made a fake breakout, and I know after this breakout, so many people saw there was this retest and they'll be waiting to enter after the retest. No, you don't do that. Yeah, you just simply don't do that. What you do, like we did in the previous ones, you look to the left where there is an area of confluence that the market was initially playing. If you look to the left here, we have an area of confluence around this region. It's a supply and demand zone. So before price finally breaks to this downside, look if it has tested this supply and demand zone to the left where there is a lot of price movement. Yeah, look at that region. If, like, for example, here the price has tested it, it was consolidating here, then it finally tested that area of confluence to the left, then broke. But if you look here, initially it came close to testing this area of confluence, but it never reached. Yeah, then it came with a fake breakout, then went back inside, finally go and test this area of confluence before breaking to the downside. That's what price usually do, and many people will think that the price is being manipulated. No, it's not being manipulated. That's how just that's how the market works. Yeah, basically that's how the market works. Okay, let's go further down. Can also, okay, the first TP, just measure that inside of the channel like that. Come and put your, let me measure it properly like that. Come and put it here, and that's where you collect your maximum profit for the first TP. The first TP is usually 99.9999% accurate. Yeah, that one you can trust me on that. It's 99.99% accurate. Imagine this was the daily time frame. You entered your trade around this region, area of supply and demand zone, and did hold till price reach here. Imagine what the amount of money you could have collected just being patient. Yeah, the market really tests people's psychology. It isn't really, this technical analysis also plays a basic role in trading, but the most important thing in trading is psychology. It really tests your psychology and emotions. And if you're a person, and this market wants you to be just an observant person, even if you look here, we have something we call the QM, the Quasimodo, and also call it the, what we can call the head and shoulders pattern. If you look here to the left, we have the shoulder here, the left shoulder, the head, and the right shoulder. What you do is this. Let me first remove these ones and put them aside. That is the left to the, there's a left shoulder and the head. Then here also have the right shoulder formed, and then you put your rectangle like this. So even if you did miss your entry at this region where I drew the trend lines earlier like this, let's say you missed your entering at around this supply and demand zone, yeah, and you saw this, what we call the Quasimodo. This is called the Quasimodo, the left shoulder, the head, and the right shoulder. And you saw this, if you've been in the market long enough, through experience, you'll know this. And I'll also teach you this for a very long time. I'll teach you until you grasp it. It's easy. It's just a matter of practice, patience, and being observant. If you missed entering at around this region and you saw it made this pattern and came back here to make this left shoulder, the head, and the right shoulder, you would have entered here for sales and you still would have made a lot of money. We call it the Quasimodo, the QM. This would have been the QM for sale because it's the head and shoulder pattern that it made. Yeah, but it just requires you to be observant. Let's further proceed down. Okay, even here it's there's of something, and okay, let me see. We have that, and to the downside, make sure it touches only the wicks like that. Yes, we have a bearish flag, and a bearish flag usually goes down, breaks to the downside. And even if, let's say, you had a big account and you've seen that this is a bearish flag, and I sometimes do it, I just enter a sell if I have known that and I've seen that this is a bearish flag, that it will go down. I just enter anywhere. If I have a big account, I can just enter anywhere, but with a smaller lot size that won't affect my account, because at the end of the day the bearish flag will go down. Okay, and you might be trying to ask yourself, why are you not seeing the area of confluence in this to the right, or what? There's something we call the fair value gap. Yeah, I'll also teach that in the next class. But the fair value gap is just like, for example, here we have an imbalance. Around this region there is an imbalance. Price made all this move without collecting other orders around this region. And being that there is an imbalance, meaning there are orders left around this region, even without that supply and demand zone, this imbalance acts. Okay, that imbalance acts as a supply and demand zone. It acts like that, and it also works. I'll teach a fair value gap in my next video. Yeah, kindly subscribe, hit the like button, comment and share. I'll be giving free forex knowledge and signals. Yeah, kindly subscribe, help me reach 10k subs. I'll be glad. I hope you're family here. I'm here to give you free forex knowledge and to enlighten you on how to keep it simple and as simple as possible. Yeah, and guys, please do not force trades. Okay, if you force any trade, you're the one who will lose your money. The market won't lose anything because you are forcing trade, trying to make profit, even where there was no trade that. Okay, in short, I mean, do not force trades. Here I also saw something. The market was bearish. We only look for bearish patterns, flag patterns, pennants, and the rising wedges. They break to the downside like this. This was a bearish flag. It breaks to the downside. The same applies to the left. You look for areas of confluence like that. You put your shoulders on there. Wait for price to come there. Just be patient. Price must always come there. And if it doesn't, okay, just call it that. You should not chase trades. You should not FOMO here. There is no need of FOMO. You wait for price to come to your supply and demand zone. It always does. Most of the time it does. And if it doesn't, you call it, just leave. Just leave. For you, it's better to be safe than sorry. This is the forex market. You cannot combat the market, okay? There is no need of combating. You wait for it to come. Put your traps around this supply and demand zone. You can collect your orders. Then for your stop loss, for those who use stop losses, put it just a few pips above the wicks, like this wick here. You put it up a few pips. Let me show you. You'd put it a few pips above that wick like that. Then your TP, as usual, you know, your TP, you do this after measuring. Then you come and place your TP like that. It's usually very accurate. You can see for yourself. It's usually very accurate. That is your first TP. Only take the first TP. Do not be greedy. Take the first TP and leave. There's a lot of other setups you can find elsewhere in the market. The market is generous. It gives and it also takes in equal measures. It just plays with your psychology. They hit you with psychology. Okay? This was if so. What I meant was this. For example, there was you put your sell limit around this supply and demand zone like that. Your SL will have been somewhere above, like $2.30 for those who used. For example, if I used the one lot size, and this to volatility to 51x index, then my TP would have been like somewhere around here, this shadow zone area. I would be willing to lose $2.30 to gain $10.13, close to ratio 1:4.5 there, and that's a good risk to reward ratio. That even, for example, if my strategy was 50% correct, I'd be still profitable most of the time due to the right or the correct risk to reward ratio. Okay, the characteristics are the same for these flags, pennants, and let me say wedges. Okay, and guys, let me do the last one, then we can call it a day. Let me show you. It's just the same. There's nothing rocket science here. Okay, I see something here. Let me try to try and see if it's clear. If it's not clear, then I'll just leave this one. Let make sure it touches only the wicks like that. Here, if you can see, we have a rising wedge. Let me see if it has reached the first TP. Measure the inside like that. Then you come and put it. It's almost there. It's almost there. First TP. It's almost reaching there, and it must reach there. It's usually accurate. It must reach there. And if you look at the area of confluence, I said you look to the left. You see, here was an area of confluence here, that place. Let me show you. Here is an area of confluence. The price broke that structure, and it's now coming back to test that area of confluence, what we call the supply and demand zone, and it came back around that region, and it even did touch. If you put your, let me put the horizontal one so you can see. It came back to that point and touched it left a wick that touched that supply and demand zone before going to the downside. Imagine if you put your sell limit. Let me show you. If you put just your sell limit, you've seen the flag, then put your sell limit around this region. A lot of orders around that region. Then your SL, you put just above that demand and supply zone, above like that. For your TP, you put around this. The risk to reward ratio is very good. Yeah, you'd have a lot of money with just this risk to reward, depending on your lot size. If you have a small account, just use. If you have a small account, use just a small lot size. Be fair to your account. Okay, use something reasonable. Do not be greedy. Greed is what kills a lot of people in this line of business. And guys, remember to subscribe. And again, I ask you, help me reach 10k subs. I'll be giving you more forex knowledge, more forex knowledge. This is just the tip of the iceberg. And guys, thank you for watching. Click that subscribe button. It costs nothing. Just click, hit it, comment. And if you have any question, leave it in the comment section. I'll see it and get back to you. Thank you for watching. Ciao.